The 2017 Trump tax cuts brought significant savings to real estate investors, but many of those benefits are now on the chopping block. With key provisions set to expire, Congress is facing a major decision: extend the cuts or let them sunset, bringing tax hikes across the board. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to the RealWealth Show with Kathy Fettke, the real estate investor's resource.
Today, we're bringing on Brandon Hall, who's a real estate investor and CPA with a specialty in real estate taxes. We'll cover critical tax deductions like bonus depreciation, cost segregation, SALT caps, child care tax credits, estate tax exemptions, and more. So let's bring on Brandon. Brandon, welcome to the RealWealth Show.
Yeah, thanks for having me, Kathy. I'm happy to be here.
Well, I'm so glad you're here because there's a lot going on out there. a lot of changes coming. So let's go back and take a look at the 2017 tax cuts.
Yeah, so there were a ton of tax cuts across the board. So President Trump, then President Trump, he had Congress push through the 2017 Tax Cuts and Jobs Act. And I would say for real estate investors, the main things that were a big positive were 100% bonus depreciation. It was previously 50% bonus depreciation. And then the qualified business income deduction. So the qualified business income deduction is a 20% deduction on the profits that your business makes. So if your business makes $100,000 in net profits, you get a free $20,000 tax deduction that you can claim against those net profits. So that's the QBI, qualified business income deduction. And there's probably one more big one, which was the opportunity zone tax credits or just, I guess, tax legislation that went into play. But everything is kind of on the chopping block right now, and that's what's got everybody a little uneasy. This year, we currently have 40% bonus depreciation because bonus depreciation, though it started at 100%, was set to phase out. So this year's 40%, 2026 is 20%, and then 2027, 0% bonus depreciation. And that obviously has a lot of investors worried because a lot of us are used to, one, low interest rate environments, but two, cost segregation studies and getting that bonus depreciation up front, which creates a large tax loss. So if bonus depreciation is phasing out, it doesn't stop you from doing a cost segregation study, but it does make the ROI on a cost segregation study a little less valuable.
Yeah.
So, how does that impact acquisitions and things like that? And we've seen a slowdown, which is probably coupled with rates as well, with where they're being at their inflated levels. But we do see a lot more of a conversation around, should I get a cost segregation study done or not? So Congress is, the Senate and the House are both Republican controlled. But the only way that they can pass legislation is through the budget reconciliation process, because it requires a simple majority. Doesn't require like the 2/3 vote and all that type of stuff. And that's what Congress is going to need in order to pass any sort of tax legislation that is nonpartisan. So in order to meet the budget reconciliation process, you have to balance the budget. And the problem is that a lot of the 2017 Tax Cuts and Jobs Act, like extending it, is going to create some, there's different estimates out there, but like anywhere from like $3.5 to $4.8 trillion in deficit over the next 10 years. So you're going to see, like, over the coming months, Congress is going to do battle around what are the provisions here that we do not want to expire at the end of 2025 and we want to make permanent.
I know a lot of investors want to see that bonus depreciation come back. What's your thought on that? Do you think there's a chance it will make it through?
I think bonus depreciation will, because bonus depreciation is bipartisan. Was it early last year? Maybe mid last year. I can't remember exactly, but there was legislation produced last year. I think it was actually Q1 of last year. That was bipartisan legislation. And the goal was to make 100% bonus depreciation come back into the fold, as well as expensing of R&D costs. So we have a lot of software developers that we work with as well. And when they're when you're running a software company, It used to be that you could immediately expense R&D costs. Now you have to amortize it. So it's really messed up their P&Ls and their tax liabilities. So we saw bipartisan legislation be introduced last year that did make 100% bonus depreciation come back into the fold, as well as that expensing of R&D costs. So I do think that 100% bonus depreciation will be, I don't know if it'll be 100%, but I do think bonus depreciation will be made permanent through this legislation. So to what level? Is it 50%? Is it 60, 80, 100? I'm not sure. But it does have bipartisan support, and it is pro-growth because you have depreciation recapture whenever you sell an asset at the end, right? And so the idea is with bonus depreciation, we encourage capital investments because we're getting an immediate tax deduction for it, but we're still going to be able to capture that the loss in tax revenue at some later point. And also, thanks to these capital investments, where we are increasing the GDP growth. So that's why it's pro-growth. And that's also why I think it's bipartisan.
I was just going to ask you that. Why would it be bipartisan? Because usually the argument is, well, tax cuts are going to increase business, right? And that creates more tax income elsewhere.
Yeah, and bonus depreciation is an interesting one because, like, the qualified business deduction, for example, that 20% deduction on net profits, like, that's just a straight up cut. I don't know if that's really pro-growth, or at least to the extent that they thought it might be pro-growth. But bonus depreciation is truly something that it's a timing difference, right? You get a deduction today, but you're going to pay the IRS at some later point when you cash out and call it a day because of that depreciation recapture. So because of that, and because of the GDP juice that it provides, it's pro-growth and bipartisan.
Well, when it comes to real estate, the only way you wouldn't have to pay that is if you die, right?
Yeah. You can absolutely die. You're more than welcome to do that. But yeah, that's when you die, your heirs get a stepped up basis in the asset equal to the fair market value, which would eliminate the depreciation recapture as well. So that is a strategy that a lot of our clients are planning for. Yeah.
No, not planning to die, but planning. Yeah, got it. Okay.
Planning on the estate stuff. Yes.
Yeah. All right. And when are the 2017 tax cuts set to expire?
So there's quite a few of them that are set to expire at the end of this year. So Congress is on the clock. So you've got 100% bonus depreciation. You've got qualified opportunity zones, the qualified business income deduction, that 20% deduction that I was talking about. You've got the standard deduction. So right now it's $24,000, but it's set to revert back to 12. I think that's for a married filing joint couple. So that happens at the end of this year as well. And the standard deduction was actually kind of interesting because when it came into play, a lot of people itemized deductions, but because the standard deduction was so large, we saw a lot of our clients stop itemizing deductions because their itemized deductions were not in excess of the standard deduction, which is actually kind of good because if you itemize 1 year, then you have to claim any sort of state refund the next year. So it gets kind of confusing to continue to itemize deductions. But standard deduction is going to revert back to the pre-2017 levels. There is the SALT cap limit of $10,000. That's going to change. The mortgage interest deduction, alternative minimum tax is going to come back into play, and typically not an issue for real estate investors unless you work in the tech sector where you get a bunch of RSUs and stock options. That's all subject to alternative minimum tax. So it essentially creates phantom income that you could be exposed to. Has not really been an issue since the 2017 TCJA, but at the end of this year, if that's not fixed, that's going to come back. Personal exemptions will come back into play. The child tax credit's going to be reduced. So there's a lot of things. There's a lot. The estate tax is also a big one. That's going to be cut in half. That exemption that we were just talking about. So there's a lot of changes, and I think that you'll see a lot of back and forth in Congress here. I think you'll see a lot of action fast, and then I think that it'll be slow. And I think we'll probably see something passed by the end of the year.
Now, the SALT deductions was a big issue for those of us in high-priced markets like New York and California. Why is that? Why did people in high-priced states not like the SALT deduction?
Yeah, so prior to the 2017 TCJA, you could itemize your deductions by deducting mortgage interest and then state and local income taxes, as well as charitable contributions. But after the TCJA, the SALT limit came into play, and it's a $10,000 limit. So where previously, if I'm in California, which charges, I think their maximum tax rate is like 13.3%, if I make $100,000 in California, well, that's a bad example. If I make $1 million in California, my California state taxes might be like $100,000. So prior to the TCJA, I could claim $100,000 on my Schedule A as an itemized deduction. But after the TCJA, that was capped at $10,000. So I could only claim 10 of the 100K. But what you also have is you have your personal property taxes, like your vehicles, the house that you live in. You could deduct all of those property taxes as well. And so all of that in the aggregate, state income taxes and property taxes, was capped at $10,000 and really hurt people in either high property tax states like Florida, Texas, or high income tax states like New York and California. But it was the Republican Congress way of paying for all the other cuts, right? So it's like, well, if we want to do 20% QBI deduction on my business income, we have to pay for that somehow. So let's lop off everybody's ability to itemize tax deductions going forward.
Well, that eliminates what a lot of people were saying, is that Trump was just trying to get back at New York and San Francisco and LA. If Texas and Florida were also suffering from this, then it wasn't necessarily a political move. Perhaps
it might have been a political move. I mean, there's different opinions on that, but a lot of people in a lot of states were impacted. It was not just California and New York.
Got it. Okay. So is there any talk of how that might change this year? Any change to that limit?
I actually don't. The problem with the SALT cap is if you take it away, you end up creating large tax deductions for people. And so that has to come from somewhere, right? Like that's cutting the government revenue. And again, the challenge of the Republican Congress is that they have to balance their budget. They have to go through this budget reconciliation process. So if they allow the SALT limit to either go away or be lifted a little bit, then they have to find a way to make up that revenue. My guess is that the SALT cap limit is going to stay exactly where it is.
Okay. All right. Well, one can hope, right, for a change. All right. So the child care tax credit, with the exemption being reduced by half, I would think there's going to be change with that. People are there's so many young families today who are paying so much in child care. It's hard to get ahead.
Yeah. And you see JD Vance too. He's talking about how he wants more families or more kids to be had in the U.S. So I think that I would be surprised if the child tax credit reverted back, if they let it revert back to where it was pre-TCJA. My guess is that it might even be expanded a little bit.
Okay. Yeah. I mean, there's been a lot of talk of that. Now, the back to the bonus depreciation, a lot of people were getting the short-term rental kind of loophole, getting those massive deductions by buying a short-term rental. But this year isn't that great if it's down to 40%. So as investors prepare for 2025 and how they should invest or what they should sell, it doesn't really sound like that short-term rental loophole is going to be very good this year.
You know, I think it's just part of underwriting. It's just like anything else, right? Like interest rates go up. It doesn't necessarily prevent you from buying the next deal, but it does factor into your underwriting and your approach. I think it's the same thing. It's still a really great way for people with full-time jobs or running a business full-time like myself. We can't qualify as a real estate pro, right? Because to qualify as a real estate professional, you have to spend 750 hours and more time in real estate than anywhere else. So if I'm working my business full time, I cannot possibly convince the IRS and especially tax court that I spent more time in real estate than running my CPA firm.
Yeah.
In real estate professional status, that's like the apex of tax planning for real estate investors, because it enables you to use all of your rental losses from the cost seg studies and just repairs and improvements that you might make. Your rentals are going to create tax losses. And if you're not a real estate pro, they become suspended on your tax returns and they get carried forward in general. But for people that work full time, you can't qualify as a real estate pro. So that's where the short-term rental loophole comes into play. There is a special carve out if you own short-term rentals. There's a few rules associated with it, but if you're buying a short-term rental today, even if you don't have bonus depreciation, even if bonus depreciation is zero, the cost seg study will still likely result in a tax loss in the first 5 years. Every year for the first 5 years would be my guess. So it's still valuable. It's just not as valuable as 100% bonus depreciation.
Now, you talked about cost seg earlier, and again, I know that we have some new investors listening, and new people new to real estate. So, what is a cost seg, and how does that help you reduce your taxes?
Yeah, it's a great question. So, I'll talk about what a cost seg is, and then I want to talk a little bit about some interesting. I have a YouTube channel now, and I've got some questions on like my CPA says I should never do a cost seg, so I want to talk about that too. A cost segregation study is, before I jump into that, when you buy a rental, you depreciate the improvement value. So that's the purchase price less the cost of land, because land does not deteriorate over time, and depreciation is meant to track the deterioration of your asset. So you have to find the improvement value, and you depreciate the improvement value over 27 and a half years, or 39 years if it's like a short-term rental or commercial property. So a cost segregation study is basically the practice of saying, hey, there's components that make up this property that are embedded in this property, like furniture and fixtures and some of the windows and the cabinetry and et cetera, et cetera. They're not going to last 27 and a half years. So let's identify those components and let's assign a value to those components. And let's determine how fast we should be depreciating them. So after a cost segregation study is completed, you get a report that says you have 5-year property, meaning you depreciate over 5 years, equal to X. You have 7-year property equal to Y. You have 15-year property equal to Z. And then the rest is that 27.5-year property. And once you take that study and you get it into your tax returns, what you find is you get to depreciate the 5-year property over 5 years versus 27.5 years, which accelerates the annual depreciation that you're able to claim. So that's what a cost segregation study does. It's basically just the practice of saying there's a lot of stuff in this property that's not going to last 27.5 years. So let's assign a value to it, and then we'll be able to depreciate that a lot faster. We'll depreciate carpet over 5 years versus spreading it all out over 27.5 years. And then bonus depreciation comes into play, because bonus depreciation, you're able to bonus depreciate any component with a useful life of less than 20 years. So the 5-year, 7-year, 15-year property that I just talked about from a cost seg study is all bonus eligible. And that's where that 40% bonus depreciation would be deployed. So that's what a cost segregation study is. Now, there's a lot of misconceptions about cost seg studies. So the very first thing that you'll see the CPA community talk about is, well, you always leave out depreciation recapture whenever you hear cost segregation people talk about the value of cost seg. And it's true, you do need to be aware of depreciation recapture.
And what that means is if you sell it, you have to just pay those deductions, but you have to pay the tax back. That you got
exactly
massive deductions in year one, but when you sell it, you pay the IRS.
100%. Because if you buy, it's a very simple example, you buy a property for $100K and you later sell it for $105K, you will, most people listening to this, especially if you're a new investor, you'll say, yeah, I made $5,000. But then you talk to the accountant, and the accountant goes, well, what is your adjusted basis in the property? And that accounts for all the depreciation that you've claimed. So if you took all this depreciation up front, thanks to a cost seg study, and let's say in this example, it was worth $30,000 of depreciation, then you bought the property for 100, you depreciated it 30. So your basis, your adjusted basis is 70. If you sell it for 105, you have a $35,000 gain, 30 of which is considered depreciation recapture because it comes from depreciation that you originally claimed. So yeah, so you have to recapture it. but it's not a reason to not do the cost seg study. It's just a factor in your net present value calculation. You can literally like spreadsheet math this stuff all day long. And what we have found is if you're going to hold a property for like 2 or 3 years, then the cost seg study might not be worthwhile. Or if you're buying property less than 500K in value, then the cost seg study might not be worthwhile. So there's some potentially not worthwhile situations, but for the most part, and this is true even if bonus depreciation is 0, because we've modeled that out as well. For the most part, the cost seg study is still going to be a positive net present value for you, which means that you should undertake that project.
Oh, I didn't realize that you need, like, what's the ideal amount of time you should hold it if you do the cost seg?
Well, I mean, the longer that you hold it, the better, right? Because what you're doing with the cost seg study is you're getting a large tax deduction now, or at least over the first 5 years. And that's creating a reduction in your tax, meaning that you have extra cash that you can go and invest. So the longer that you allow that extra cash to stay invested, the higher the ROI is going to be at the end of the day, and the higher the NPV is going to be for the net present value is going to be for you. But like most of our clients will hold a property for 7 or so years, and so you can model that into the cost seg study and kind of see the exact like present value impact of that.
Fascinating. Okay, well, what else should investors be aware of this year, and specifically real estate investors?
I would just say to just really keep an eye on the tax legislation. I mean, from my perspective, from the CPA perspective, that's the thing that we're focused on this year. It's what a lot of our content is turning into is keeping everybody updated on what's going on in Congress. That's probably what I would pay attention to, because there's a chance that bonus depreciation could be made 100% and made retroactive to some point in 2025. So probably not going to impact your 2024 tax returns. So go ahead and file those. But for next year's tax returns, 2025 tax returns, there's a good chance that bonus depreciation could be 100% starting January 1st, 2025, which would have been 40 or so days ago, 37 days ago. So that's what I would probably pay attention to, is just where are we at with the bonus depreciation piece. But opportunity zones are another interesting one that I think is frankly undersold and undermarketed, but a super powerful tool. So for real estate investors specifically. So if I'm a real estate investor, those are probably the 2 things that I'm most paying attention to in the world of taxation this year.
And with opportunity zones, do you think, is there talk that, because that's about to expire, right? Or not?
What has expired with opportunity zones is the ability to kind of like, what's the right word for it? Eliminate some of your capital gain on whatever you're rolling into the opportunity fund. I think that you'll see that. I think you'll see another round of that come back into play. So that's what I think will happen. But you can still invest in opportunity zones today. As long as you invest capital gain, it can come from equities, it can come from selling a business, it can come from real estate. As long as you invest capital gains and let them ride for 10 years, the additional appreciation will be tax-free, including depreciation recapture. So it can be very powerful if you either start your own qualified opportunity fund, which we've had some clients do, or get involved with the qualified opportunity fund.
Good stuff. Okay, and there's one final thing with the bonus depreciation we talked about, and you take all these tax cuts in year 1 or over 5 years, and you sell it and it's recaptured, you have to kind of pay it back. Not if you did a 1031 exchange, right? Or would you still?
Yeah, right. So there are rules now related to the amount of personal property that you can carry over in a 1031 exchange. We have yet to see a single one of our clients actually trip that threshold. So not really an issue. But anyway, to answer your question, yeah, you can roll forward all that depreciation recapture, all the capital gain. It's a really awesome benefit. But I will say too, even if you are running into the 1031 rules, whether it's the amount of personal property identified from a cost seg study that you're allowed to roll over, or whether it's just the simple rules related to identifying property in a 1031 exchange and actually executing during the timeline that you're given, there is another option that we have coined the lazy man 1031. And basically it's you sell a property and then you buy the replacement property within the same calendar year. And then you cost segregate the replacement property to get the bonus depreciation to create a tax loss that is ideally large enough or close to the gain that you've recognized on the same property that you sold. The key is just it has to happen in the same calendar year, but it doesn't have to be in order. You could buy the replacement property on January 1st and sell your property on December 31st. But the key is just same calendar year so that you can get the cost seg study done and get the bonus depreciation flowing through.
Good stuff. Oh, Brandon, I don't know how you do it, but you make accounting and taxes so interesting. Thank you so much for joining us again here on the Real Wealth Show. And for our listeners who don't know, your company does the accounting for our rental funds.
And I love you guys. You guys are amazing clients, by the way. So thank you very much.
Thank you. And likewise back at you. You know, you're doing our build to rent fund, which is still open. Anyone interested in investing in our build to rent fund, you could do that. Just go to realwealthshow.com. But we really appreciate your attention to detail and your deep knowledge of the tax code and how it benefits real estate investors. So thank you. Thank you so much.
Thanks, Kathy. Appreciate it.
And thank you for joining me here on the Real Wealth Show. We do have a webinar coming up with Hall CPA on February 27th. Make sure to visit realwealthshow.com to register. I'm Kathy Fettke. Thanks again for joining me here on The Real Wealth Show. We'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.